We will walk through everything you need to know about VAT registration in Denmark, so you can approach the process with clarity, confidence, and full compliance. Whether you are a Danish startup, an established company expanding into Denmark, or a foreign business selling into the Danish market, understanding when and how to register for VAT is essential to avoid penalties, preserve margins, and build a professional relationship with the Danish tax authorities. Let us start with the basics. VAT in Denmark is a general consumption tax applied to most goods and services at a standard rate of 25%, one of the higher rates in Europe, but administered within a relatively straightforward and digital-friendly system. If you carry out business activities in Denmark that are considered taxable supplies, you will most likely need to register for VAT with the Danish Customs and Tax Administration, known as Skattestyrelsen. The key trigger for registration for Danish established businesses is a turnover threshold. Once your taxable sales exceed 50,000 Danish kroner over any 12-month period, VAT registration becomes mandatory. It is important to emphasize that this is a rolling 12-month period, not a calendar year, so you should monitor your revenue continuously. For many businesses, waiting until you cross the threshold is not optimal. Voluntary registration before you reach 50,000 kroner can be strategically advantageous, as it allows you to recover input VAT on startup investments and operating costs. For foreign businesses with no fixed establishment in Denmark, the rules are generally stricter. In most cases, if you supply goods or services in Denmark that are subject to Danish VAT and you are the party responsible for accounting for VAT, you must register from the first taxable transaction, with no threshold. However, for certain cross-border services to Danish VAT-registered customers, the reverse charge mechanism may apply, shifting the VAT reporting obligation to the Danish customer instead of the foreign supplier. Understanding whether the reverse charge applies is critical to determining if you must register. Now, let us look at what VAT registration actually involves. In Denmark, VAT registration is done primarily online through the official business registration portal, known as VERK. If you are establishing a Danish company, you will typically apply for a central business registration number, or CVR number, and request VAT registration as part of that process. The authorities will ask for details such as your legal entity type, ownership, business address, expected turnover, and a clear description of your business activities and industry classification. If you are a foreign company without a Danish establishment, you may be required to appoint a fiscal representative, depending on your country of establishment, although in many EU cases a local representative is not mandatory. The authorities may request supporting documentation such as incorporation documents, proof of identity for directors, and evidence of planned economic activity in Denmark. Processing times vary, but in practice, registration is often completed within a few days to a couple of weeks, assuming documentation is complete and accurate. Once you are registered, you must charge VAT on your taxable supplies, issue compliant invoices, and file VAT returns on a regular basis. Danish VAT invoices need to include specific elements: your company name, address, and CVR number, the customer's information, an invoice date and unique invoice number, a clear description of the goods or services, the quantity, the net price, the VAT rate applied, the VAT amount, and the total amount due. For cross-border B2B transactions within the EU, you will also need to include your customer's VAT number and often indicate that the reverse charge mechanism applies, where relevant. On the reporting side, most new businesses are assigned a quarterly filing frequency, although as your turnover evolves, this may shift to monthly or semi-annual reporting. Returns are filed electronically, and payment is made via the digital systems used widely across Denmark's public sector. It is crucial to adhere to filing and payment deadlines, as late submissions can attract penalties, interest, and increased scrutiny from the tax authorities. On the input side, Danish VAT is recoverable on most business-related purchases, such as raw materials, professional services, and many operating expenses. However, there are important limitations, particularly around certain staff-related expenses, entertainment, and passenger cars, where deduction is restricted or disallowed. Maintaining robust bookkeeping and keeping invoices that meet the formal requirements is essential to support your right to deduct input VAT in the event of an audit. In addition, if you are engaged in both taxable and exempt activities, such as certain financial or healthcare services, you may need to apply a pro rata calculation to determine how much of your input VAT can be reclaimed, which adds a layer of complexity that often benefits from professional advice. For e-commerce and digital services, EU-wide rules also come into play. If you are selling digital services or certain B2C goods to consumers in Denmark from elsewhere in the EU, the one-stop shop schemes may allow you to account for Danish VAT through a single registration in your home member state, rather than registering directly in Denmark, provided the relevant conditions are met. This can significantly simplify compliance, but you must ensure you are correctly classifying your supplies and understanding where your customers are located. Failure to do so can result in underpaid VAT, retroactive assessments, and administrative burdens. Looking ahead, the Danish VAT environment is highly digitalized and data-driven, with the authorities increasingly using technology to identify inconsistencies, missing returns, or unusual patterns. For businesses, this means that accurate, timely reporting and clean digital records are not just good practice, they are a practical necessity. Investing early in appropriate accounting systems, clear internal processes, and where needed, external tax or accounting support, can prevent costly errors and free up management attention to focus on growth rather than remediation. To summarize the key points you should take away from this overview: determine early whether your activities in Denmark trigger VAT registration, monitor your turnover against the 50,000 kroner threshold if you are established locally, and recognize that foreign businesses often have to register from the first taxable transaction. Use the official digital channels to complete your registration, ensure your invoices and records meet Danish requirements, and stay disciplined about filing and payment timelines. Where your activities involve exemptions, complex cross-border transactions, or mixed taxable and exempt activities, engage with a qualified advisor to validate your approach. By treating VAT registration and compliance in Denmark as a strategic part of your market entry or growth plan, rather than an afterthought, you not only avoid sanctions and reputational risk, but also position your business as a reliable, professional counterpart in a market that values transparency, efficiency, and trust.